What is going on, everybody? Welcome back to the channel. If you guys have been living under a rock lately, this market has been crazy with the Trump tariffs. The market has been selling off, and today the market did something that I personally have never been involved with since I started trading, which is starting to have fears about the price limits, especially when you're trading futures, right? Because when you're trading the prop firms in futures, TopStep, Apex, MyFunded Futures, Tradeify, pretty much every prop firm, they have a price limit rule where you can't trade within 2% of the price limit. So I'm gonna break it all down so that you guys can understand the rule and stay on the right side of this rule that they have. So before we get started, you got to understand what a price limit is. It's basically a circuit breaker. So a variable price limit is a type of circuit breaker used to maintain orderly trading conditions. It is associated with commodities futures markets, which are known for their occasionally high levels of volatility. Once given future contracts have reached its price limit, the exchange may allow its trading to resume within an expanded upper or lower bound of prices. Those new minimum and maximum prices are known as variable price limits. How price variable limits work. Commodities futures exchange operators such as the CME, Chicago Mercantile Exchange, use price limits to control the maximum amount of volatility permitted within a given day. If a particular commodity rises or falls by more than the maximum permitted amount, the exchange operator can either freeze trading in that commodity or it can continue trading within its variable price limits. Oftentimes, the exchange will first freeze trading, then resume trading the following day within the variable price limits. This approach allows a cooling off period and permits traders to more easily unwind their positions the following day. If successful, these measures will first prevent any potential panic or speculative mania from taking hold in the market and then allow for prices gradually to recover to fair value. So, pretty much in extreme cases where the market dumps aggressively and hits, a certain limit, they will look to first stop trading altogether, and then potentially they could just close down the entire market for the day. But this is very, very rare that this happens. It's basically, I mean, you could think of it exactly like a circuit breaker where, if there's too much energy, then your circuit breaker will pop. Well, if there's too much movement in the market, mainly to the downside, where it's going to cause fear, panic, mania, then they can basically turn the stock market off, let things, rest for a little bit, and then reopen it up and kind of let people adjust to what's going on. So the circuit breaker is probably like the best term for this because of how it's supposed to kind of stop the panicking from happening or stop the overload of the market. Most of us who are trading futures are probably trading equities, especially when we're talking about the prop firm game. You're probably trading NQ, and if you're not, then ES or YM. So equities, equity index futures have three levels of expansion. They have 7%, 13%, and 20% to the downside, and then a 7 limit up and down in the overnight trading. So basically, all this means is that 7%, you'll get a freeze. If it goes 13% down, you'll get another freeze. And then at 20%, that's when the stock market will shut off for the day. So you have like basically a cool down, another cool down, and then a shutdown. And that's only to the downside. But we have a 7 limit up and down for overnight trading. So for overnight trading, if we were to go 7% up or 7% down, then you would get a cool down for that because of the fact that it's an overnight and trading that far in the overnight is a lot. Now, the reason again for this is at that 20%, that's like it basically they're trying to stop a collapse of the market, and the any stock market collapse after 20%, there's like massive fear and panic. I mean, that's what causes market crashes. So they're just trying to prevent that, and that's why they have the different cooldowns and the shutdown at 20%. Okay, so now that you guys understand all of that, now we can apply it to the prop firms. So prop firms have a 2% price limit rule. So if we use ES, NQ, YM, for example, basically 7% is going to be our first circuit breaker. But they don't want you trading up into the 7%. They have that 2% rule. So that means at 5%, that is when they want you to stop trading, right? So if the market is to go 5% down, you can't trade the market anymore because you're close to this 7% cool down, right? And anything below five, I mean, we could go to 13%, you still wouldn't be able to trade it, right? And the reason why is because the volatility at that point will spike up and potentially getting down to that 7%, 2% more. If there is a stoppage of the market when it reopens, the volatility could end up messing your position and blowing your account potentially, and not really giving you a chance to get out of your position. So that's why they kind of have this 2% buffer rule. So the price limits are calculated based on the end of day settlement price, and they vary by product, contract month, time of day, i.e., overnight price limits differ from regular business trading hours, which again, it just depends on what you're trading. Because obviously, like ES and Q equities, we already showed that those are the exact same. They're just treated differently depending on up or down, right? Because going down is really more so what they care about than going up. Because if the market's going up, nobody's fearing or panicking. I mean, people are just going to load into positions to try to continue to move up. But when it's coming down and fear and panic are in the market, that's when things can snowball pretty quickly. And right here is just an example using ES. So basically, they have the top of the open, which is just the settlement price, and then your allowable trading zone within the -5%. And then as soon as we get below the -5%, that's when it's the no trading zone. And then once you hit the price limit of 7%, that's when you get your first halt. And then once you get to -13%, you get your second halt. And then if we ever got to -20%, that is when the market would close for the day, because a potential stock market crash could happen, and that's what they're trying to avoid. And then again, the reason why they're enforcing this is because they're trying to protect the firm and the traders. They don't want for your price to get skipped over during this volatility and the volatile period of time when the market is just reopening up from halting. Because if you've ever seen, I mean, it doesn't have to be ES or NQ because it doesn't happen very often, but on regular stocks, those get halted all the time. If you've ever been a part of a stock market halt before, or not stock market halt, but a stock halt, then you know when the market opens back up or when that ticker opens back up for trading, it can be extremely, extremely volatile. So you just got to make sure that well, you can't do it anyway, but if you're trading on your own personal account, then you just got to know, like, hey, if I'm holding through this, it's going to be really volatile when this thing decides to open back up. So I got to be very, very careful. But yeah, I hope this explanation helped you guys. I hope you guys, didn't blow any accounts today. I know the only one, at least for today, that actually hit 5% down was NQ. Um, and at the time of this recording, I believe that it didn't go too much below 5%. I think it went to like 5.14 down on the day or something like that. So it wasn't like untradeable, but yeah, you just got to be really careful when we're this bearish and we're hitting some of these price limits that we're not allowed to trade on these prop firms. So that's all I got for this one. Please make sure you guys hit the like and subscribe button if you like videos like this, and I will catch you on the next one. Peace.